welcome to the Capital Discussions Roundtable. I'm Tom Nundermaker with Jim Riggio and Himanshu Raval. Before we get started, a quick disclaimer: the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. If you don't know your situation and have no way of knowing what level of risk is appropriate for you, we're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that out of the way, I will pass the ball to you, Jim, and welcome back, Himanshu. Always a pleasure to have you.
Thank you very much. Always a pleasure to be here.
Okay, now I'm just trying to share my desktop. And
looks like it's loading.
It didn't tell me which desktop I was sharing.
Indemnitas Opportunity Fund.
We don't want that screen. No, we don't want that screen either. Hang on, and we will come to you. Be a little bit small. The problem is that the screen that shares, okay, on my Apple, it's because it's a multiple monitor, didn't end up sharing properly. So, but there we go. That should look reasonably decent. Okay.
That's it.
Thank you, everyone. Thank you for everyone attending. I'll be going over. Himanshu and I have been working on modifications to a trade that I originally put together probably about 5 years ago. And the market has changed a lot since. So I had been working on, and I hadn't shared, a bunch of modifications, and Himanshu contacted me a few months ago and told me that after watching the WebExes that I had done on this multiple times, he made a whole bunch of modifications, and what we found was that we were trading this thing nearly identical. So we kind of normalized what we were doing, and we decided to kind of end up giving you an update on the Kevlar. Now, it's not a brand new trade per se. It's really based on the market environments. So we'll still use the old trade if the market environments end up getting to a certain type of volatility structure or regime. But currently, and currently I mean by like the last two and a half years, the volatility, skew and term structure things have really ended up changing significantly so that we end up using this new version. Having said that, I'll walk you through this. Same disclaimer that we just said. We'll end up getting you the slides. Tom, at one point, you'll end up just including the download for the slides at this point. We're going to take you through basically 3 steps. We're going to talk to you a little bit about the way we approach putting together a trade, the methodology that we end up using, how Himanshu and I end up looking at this. We'll also then kind of take you through the anatomy or the breakdown of how we put together the trade and the specific pieces. And then we'll end up showing you both some backtest stuff and live results. Okay. Our design approach was basically, we look at 3 objectives. The first one is obviously, we want to not lose money or at least control our losses. The second thing is, and we've done this a lot in the Trading Group 1, we've ended up showing how we build trades where the Greeks will trend against us before the P&L will. It's a very interesting thing. I'd advise you to go back, take a look at some of the Trading Group 1 things. You'll see that here also. And then the last thing is positive expectancy. Everybody talks about, oh, this thing won 90% of the time. Now, just because your trades win 90% of the time doesn't mean that it's a good trade. What happens if you only win, 1 and you lose 20, okay, dollars on a trade? Well, there, you're going to have a negative expectancy, right? Because the thing is that you're going to end up winning 10% of the time, but when you win, you're only going to win 5% of the money that you lost, okay, when you ended up losing. So it's very important that you take a look at expectancy, okay? And that's the way we take a look at it, both percentage winners and then how much is my average winner versus how much is my average loser. And it's even a little bit more than that, right? It's actually the distribution or the size of the individual winners versus the size of the individual losers. A lot of this is like the way the NFL used to be before the rules have changed and basically they play two-hand touch now. But it used to end up being the old adage of offense and defense wins championships. And that's what we want to end up doing here. We want to make sure that we end up having a trade that when we have losers, it's not going to end up being something that's hurts us significantly. Now, I told you our approach. What you have to end up realizing is what's your risk tolerance level. There are going to be trades, okay, Himanshu and I are going to end up keeping things on. He's going to end up showing you an example where the loss was, it got to end up being, near our maximum loss. We were very, very worried about it, but we got through it. Okay, so we know what our risk tolerance level is, that you need to end up knowing what your risk tolerance are. What we always do is we're always playing the probabilities. We're always saying, I don't know what's going to happen in the market, what happens if, and I always want to make sure that when I take a look and I do my fire drill, if you will, taking a look what happens if I'm down 1 standard deviation, 2 standard deviations, 3, we need to make sure that we have very good probabilities based on where we are. Sorry about that. The next thing is that you have to end up understanding the market that you end up having. You can't just trade one trade for all environments. How high is the volatility? How high are the puts trading below the money versus at the money? Those things are all very, very important. The last thing is you need to understand where your edge is, because if you don't understand where your trading edge is, you're just gambling. Okay, so it's really, really important. How do you end up getting all of your ducks in a row? Cute slide, huh? How do you get all your ducks in a row? When you take a look at the different trades. When we took a look at the 2 different trades that we have within the Kevlar, we realized that the initial one, we had to end up redesigning. We had to take a look at, because the 2 things that had happened, and we've spoken, Himanshu and I have spoken about this in the past. Number one was that we started to have a negative volatility skew. And by that, what I mean is that the puts, the implied volatility of the puts far below the money, were significantly higher than the volatility of the puts at the money, looking at the implied volatility. And you remember, the implied volatility is basically determined by price. The more expensive something gets, the higher the implied volatility goes. So what it says is that the puts below the money, when you were buying them, didn't work as well. So for those of you who had seen me present Kevlar 1, you knew that we were actually had a broken wing fly where the put wing was, significantly larger than the call wing, plus we were buying extra below the money puts, deep below the money puts. Then we were also buying deep in the money calls, or one call, to end up helping to offset what happens if the market went up. That works great when the implied volatility skew curve is relatively flat. But for a good chunk of January, we were in a 3 standard deviation move of how expensive the puts were below the money versus how expensive they were. So when it got to be that expensive, the trade stopped working, probably about 1.5 years ago. So we had to end up adjusting that. The other thing that ended up happening was that skew changed the further out in time that you went. So from a time frame, we need to take a look at what was a good time frame to enter the trade. Could we still look at that 2-month area? Do we need to make it shorter? Do we need to make it longer? So we looked at different time frames, and that's what term structure meant. When we went to design the trade, very important, not only for us to look at the Greeks. The Greeks are incredibly important, but don't forget what they show you. They show you a single point in time. Where are we trading right now at the money with this implied volatility and the way the skews end up working? It doesn't tell you, when you look at your specific Greeks, it doesn't tell you how those Greeks are going to trend based on what happens if. One of the things that we've done over the last couple of weeks in Trading Group 1 is that we took a look and saw how the Greeks would change if we were down 1%, 2%, or, 1 standard deviation, 2 standard deviations. We could actually see what would end up happening. And what Himanshu and I have designed here is something where the P&L won't take as big a hit if the markets start to move the Greeks will start to trend against us before our P&L starts to trend against us. Very important when it comes to risk management. The last thing is that we're pretty efficient in the way we end up using our capital. We use iron butterflies, which means that we end up collecting the money. Interest rates are slow. They're absolutely nothing. This is important if you have a portfolio margin account and you end up keeping your money in some very low risk thing that's giving you some type of yield. Yields are so low right now that it helps you a little bit, but it's not significant. The thing that's also different here is in this trade, what we've done is that we've also designed this one to end up working with portfolio margin as well as Reg T. If you guys knew the Kevlar one, I really designed it to end up making very efficient use of portfolio margin with kind of a disregard to Reg T margin. And of course, we're using the big 1256 contracts that are tax efficient. I was going to take this out, and Himanshu said, no, actually, this is actually a really good chart for people to understand, okay, their risk. I asked you, which would you prefer? And I showed, a constant 2% return, something that averaged, right, didn't return, but averaged 4% a year, something that averaged 6% a year, but had bigger, okay, drawdowns. Now, when I say average, all I did was that I took the 5 years, okay, and I just added them up. Now, most people can say, I'd rather have something that has an average of a 12% return. But the problem is you have some pretty big, moves in here. And what people don't understand are that losses are a lot more painful than you think, okay? It's the old simple adage, if you end up having the market pull back 50%, if you lose 50% of your accounts, from that point going forward, you need to end up increasing it. You need to double it, right? You need to increase it by 100% in order just to get back to even. And that's when, you take a look at what's the annualized cumulative return. You can see that this average 12% actually did worse than the 4%. And if I go back and I end up showing you, that was because there weren't really many drawdowns. Benjamin Disraeli, and I know that some people credit other folks for saying it, but, from my research, Benjamin Disraeli once said, the 3 worst types of lies were lies, damn lies, and statistics. You can get the statistics to prove just about anything if you end up wanting to use the right metric. Here I was using average return versus annualized return, right? And you can see that there's a huge difference. Very important to realize that the losses can end up hurting you worse than you think. And Himanshu, or would you take a look and make sure we don't have any questions going forward? Tom, if you do the same for me, because I'm not looking here. I wanted to end up breaking down the trade, kind of end up showing you the anatomy. Dave, yeah, I knew it was Mark's, the quote, by the way, is saying Mark Twain. I had read the same thing, and then somebody told me I was wrong, and I actually ended up doing research, and lo and behold, Benjamin Disraeli ended up saying it, years before, and was given credit for it. Anyway, here's the way we look at the way we put our trade together. We target this for about $10,000 to $15,000 of maximum risk at expiration. You can think of maximum risk as expiration as Reg T. If you're going to trade this in a PM account, at least initially, okay, you'll only have 40 to 50% margin requirement of the Reg T requirement. Okay, so there, we ended up taking a look at this, and we really wanted to end up getting this thing on with, more than 2 months. Okay, a little bit more than 2 months we found. So we start looking at about 72 days. We want to end up getting it on by 57 days to expiration. As I mentioned, we ended up designing this to work in today's environment. And today versus, 5 years ago, I'd say 2 big things that are different. One, that the overall implied volatility of the VIX or any single number that you would end up taking a look at is lower. The at-the-money options are trading at a lower IV. However, when you take a look at where the well below the money puts are, they're trading more expensively. So therefore, the environment we have now is a lower IV, higher or more negative put skew. Okay, The original trade works very well, but what we end up doing is that we take a look at what type of environment we have, and then we'll end up using either set of rules 1 or anatomy 1 or anatomy 2, if you will, of the trade. What we take a look at is we're trying to make 7 to 10% a month. It's usually easier to make more money with a pullback than a grind up in the market. In a grind up, it's rather difficult to end up making that 10%. We will end up having a max loss of 15%, and I do hesitate to use the word max because what we'll end up taking a look at, Himanshu and I, is we actually look at the difference between what was lost just because volatility spiked and how well are we positioned. One of the things and today's a great day. Today's a great day where you might think of, hey, the market moved down. We've moved down a whole bunch of days, but volatiility's starting to go up. But it hasn't gone up all that much. If the market's gone down even more over the next few days and volatility goes through the roof, but we're still like in the meaty part of our butterfly, this would be a great time to put on a new trade. So if we're at a point where it's a great point to put on a new trade, but we're at a max loss, we'll actually look at and seeing how do we end up adjusting. And Himanshu is going to take you through an example in a few minutes. Going forward on this, what we take a look at in the butterfly is that usually we'll use about 4 to 6 contracts in a broken wing butterfly. You can trade smaller, okay, if you want. We not only use a iron butterfly with a broken wing. Broken wing, by the way, for those that you don't know, is different size or different length wings, okay, versus unbalanced are different number of contracts. So here's the way we end up selecting our wings. What we end up doing is that the call wing is always going to end up being at least equal to, but almost always shorter than the put wing, right? The put wing is always going to be longer. So for example, our default that we'll take a look on the SPX is that we'll usually use a 40-point call wing and a 50-point put wing. Okay, we center our butterfly somewhere around the 30 to 40 delta on the put side, and you know that if you look at the calls, it's just the inverse of that, right? It would be 65 to 60. And what we end up doing is getting the long call above the money. We want the ratio. And here's the whole thing. We will play with the ratios, meaning how many contracts we end up putting on will end up varying so that we can end up getting our Greeks the way we want them. So we'll start at always looking at something even, maybe, 4 butterflies, okay, 4 calls and 4 puts in terms of the quantity of what we do. But many times we'll go up to a ratio of maybe 5 to 6 or, 4 to 5 where we're selling more put wings and we're selling call wings, okay? Our call wings will usually be the same or less in its quantity, which means the put wings will be the same or greater, okay? So that's the way we'll end up setting everything up. Now, what we try to end up doing is we try to get the long call, right? That's the highest of the 3 strikes. The long call to be slightly above the money. If we can end up getting it, anywhere from slightly above the money to not having it maybe more than about 20% or so, 20, 25%, up the, if you will, the wing. So if it's a 40-point wing, we don't want to go more than maybe 8 to 10 points below where that long strike is, okay? And you'll see that when Himanshu gives you the example. We try to keep the deltas relatively flat for each individual butterfly, and we count it by the maximum number of contracts we end up having on the put or the call side. It will usually always be the put. We try to end up keeping our deltas between about -3 and +1. We'd like the gamma to be as flat as possible, especially early in the trade. Later in the trade, it will end up increasing, but we need to end up managing it. And then we want to have positive theta, maybe about 3 to 5, okay, per contract, okay? When we take our profits, okay, and Himanshu will end up showing you this, Dave Stewart, okay, showed examples, okay, in his trade. He uses a very similar process. I coined, or I started calling it the peel process, because what I'm doing is that almost like an onion, I'm trying to end up peeling layer by layer and by layer off and taking profits throughout the trade. Okay, if you can end up taking profits and reducing risk every time you make an adjustment, it's a wonderful way to trade. Okay, and it's a process. We exit the trade immediately once we get through the loss. Okay, maximum loss. But as I mentioned to you, we will end up evaluating, and Himanshu's going to end up showing you this. We'll end up evaluating, were those losses because of where the markets moved, or was it just because of the way the volatility, the implied volatility, has changed? What I wanted to end up showing you is some back-tested results of what we've done. Some of this stuff was live back in 2011, 2012 timeframe when I was trading the old version of this. Over the last couple of years, I'll show you, Himanshu will show you some of the back tests that he had done and walk you through, at least one trade. Here were the results, okay, of what we ended up trading on this specific trade as it was designed for the rut. And this was in 2010, 2011. We did have some pretty nasty moves, okay, during this time, okay, and you'll end up seeing that. So when I asked Himanshu, well, which month would you like to show, I gave him a choice of two. I gave him a choice of December or October of last year. And the reason why I gave him a choice of just those 2 months was because this is a slide from a Goldman Sachs report that I've shared with some of you. This basically shows you the largest one-week moves in the history of the VIX. Okay, 5-day moves or 1-week moves. Okay, the largest ones in history, and history, by the way, goes back to January of 1990. Okay, and we had 2 of the 10 largest weekly moves as a percentage in the history of the VIX in the fourth quarter. So there was some huge movement, and it was very, very easy for certain strategies to get just whipsawed to death. So I thought, what a great way to end up showing you. Why don't we show you when the VIX ended up moving absolutely enormous. It moved 78% in a 5-day period. Okay, I thought that, when you have butterflies, the biggest thing is how do you end up adjusting them once you get outside the ranges, and this would be a really good example. Okay, so with that, Himanshu, I don't know if you want me to pass you the ball and you go through this, or if I should just keep play a screen jockey for you.
Well, I can talk while and I will tell you when to move forward.
Okay, that works.
All right. So this was 2013, where the market actually just kept on moving up. And as you can see here, this is in SPX, by the way. The previous one was in the rut. And as you can see, the max risk margin on the previous slide was always 40K. Here, we have reduced it considerably. Because personally, I have issues with putting 40K on the line, especially when I am, just trying to understand the trade first. I probably might do that today, but this was much better for me. So when I started doing it this way and saw the results, of course I had to get Jim's help a few times because there were certain things I didn't understand. But all in all, as you can see, we didn't have a single losing month. Of course, this is from March onwards. And the overall percent returns are also pretty good. And if you go to the next slide, which is 2014, that's you, Jim. Next slide, 2014. This is the entire year, and this includes those 2 weeks that Jim just showed in this Goldman Sachs report, the October and the December. And here also, as you can see, our margin actually never exceeded 20K. I made sure that I don't ever exceed a max risk margin of $20,000. And the PL is more or less consistent with the previous year, including the months where we had this big, massive spike in the VIX. So when Jim asked me which ones to show you, I decided that I would rather show you December because it is conceivable that most of you actually still remember what happened in December. October is a little bit too far away, and as traders, our memories are very short. We are just more concerned with what happened last week and how much we lost. So I'm going to show you what happened in December. And before I do that, in the very next, Chuck is saying, how is margin calculated? Margin is calculated the usual way. The spread minus the credit received is the amount of margin that is held up, which is different
Chuck,
than buying power affected.
Right. Chuck, the way we end up calculating it is that if on any of the tools that you might use, whether it be IB, LiveVol, Thinkorswim, OptionView, NetView Explorer, it's basically taking a look at what's the maximum I could lose at any one point between now and expiration.
Okay. All right. So here is the trade started on 11/17. As you can see, prior to the trade, the market had gone up significantly, but it still didn't look like it was going to turn around. And of course, I was totally unaware of what was going to happen next. So in the first down move that you see, the market literally went down about 100 points, almost exactly 100 points. After which, it just rolled back up and moved up by 122 points. And then immediately came down and dropped again by 100 points. So we had some significant moves within this, in the two red lines that you see. And I thought this might be a good thing to show you guys. And so let's begin. So we started with a slightly bearish, bullish bias. Because remember where that blue circle was, we were still in an uptrend, and I was more or less convinced that it will continue on the upside at least for a few days more. So we purposely decided that we would go with only 4 contracts on the call side and 6 on the put side and keep our deltas positive. So when we started the trade, this is at around 3 p.m. on 11/17. As you can see, the best part is that the delta is positive, but look at our gamma. Our gamma is minus 0.21. Theta is positive. Vega obviously will be negative in these trades, and we are okay with that. So then, nothing much happened until about 4 days, at which point in time, as you can see, the market has moved up by about 20 points. In the first slide, when we put the trade on, the SPX was at 2042, and now it is at 2060.71. We are up by 4%, which is good, because especially since we were positive delta, total 3.65% in 4 days. So essentially, what we did was, the delta, I wanted to sort of make it slightly less. So I adjusted to bring it down a little. It was actually around 16. So I did a minor adjustment, as you can see. I just took 2 of the calls and moved them up. All right, let's go to the next slide.
Also, Himanshu, I just want to end up showing what happened with the margin. Okay,
Let
me just go back for a second. So when I take a look at the cost here, okay, of 16, and then coming to here, you can see the cost of the trade went down.
Mm-hmm.
All right, because Himanshu is taking money off. Now, when you take money off, okay, he did have slightly more margin, but this was an adjustment, okay, and it's absolutely beautiful when you can end up taking, your cost of your trade, make an adjustment, get where you Greeks where you need to do, and lower the cost. Okay, I just wanted to make that one point.
Okay. All right. This is the second adjustment at day 18, and this is actually not an adjustment. We were up by 6.92%. It was time to start peeling off. So I took 1 contract off from the call side and 1 from the put side. So our 4 and 6 now are 3 and 5. So once again, our cost has gone down significantly. From 15, it has gone down to 11. We took in some profits, and all in all, we are up by about 6.92% on our original margin. But we are up 9.5 on our current margin. So let's move forward. This was day 18. So far, not much has happened. Now, prices start moving down. And as you can see, I'm saying up there, third adjustment down, which means that the prices moved down, so my deltas were more positive than they should have been, and therefore I did whatever I did in order to bring my deltas back in line. My gamma is still okay. I don't really have to worry about that at all. And my theta has increased by about 4 points since we began the trade. And as you can see, my vega, when we first started our trade, the vega was, how much was it? Minus 215. And now it is 125.
Here. Yep, there it is.
Okay. All right, so our graph looks good. Our Greeks look good. Our Greek trends are within, reasonable levels. And so we move forward to day 28, I believe. 23, sorry. Okay. This was the thing that happened. SPX drops by 34 points. It was a 2.54 standard deviation move. And I had to adjust. So I brought my puts down a little bit. And I had adjusted my calls up earlier, so I brought them down as well. And once again, my delta, gamma, and theta are okay. I actually would have preferred that my delta be slightly negative, because usually after a huge move like this, you can expect the next couple of days to be down anyway. But I'm still not too bad off so far. Any questions so far? Maybe you will have some after the end. Okay, so this was day 23. Let's move forward to day 28. Price continues to move further down. Now it is at 1993. When we started the trade, it was at 2042. Now it is at 1993. I adjusted the put side, brought it further down. Now my deltas are slightly negative. My gamma is more or less where it was. Theta has increased even more, almost doubled since we started the trade. And vega is still where it was as compared to the previous slide. So in other words, sorry?
I was going to say, here's one of the points that I really want to make sure that people understand. I want you to look at the maximum risk here. If I just go back a couple of slides, look at what happens, okay? You can see this, that every adjustment, okay, what's going on is that what we're doing is that we're taking risk off the table. You see how the numbers went down to 10,000. Now here the loss is only 8,000. This next adjustment, now the maximum loss is only at $4,000. Okay, this thing is getting pretty ugly, and as we're making adjustments here, as Himanshu is taking you through this, every one of these adjustments, as he's pulling things off, what he's doing is that he is making our maximum loss lower and lower and lower. Very important piece that I didn't say. Not only is he controlling Greeks, but he's doing it in a very efficient risk management methodology, or a method, the way he's going through it. I'm sorry, Himanshu, I just wanted to really point that out, because I think that's one of the most, important things in terms of why, we don't get killed in these trades, is because as we end up adjusting, we're taking risk off the table when things get ugly.
Yep. Okay, so here we just we adjusted again. Our deltas are back in line. Gamma is okay, theta is okay, vega is okay. So we don't have to worry much, except hope that the market continues to go down a little bit, which is precisely when it doesn't. As you will soon see. There you go. The market now moved up back to 2046. Literally, the market moved up by 34 points, another 2.0 standard deviation move to the upside. So I had to readjust on the call side. I am down 5% of the current margin. Overall, out of $14,000, I'm down by only about 2.7%. So I'm still okay. Delta, gamma, theta, and vega are still okay. So essentially, after this adjustment, I don't have to do anything. So I did. And
Okay.
as we move forward, you will see what happened. Literally
Right.
from
Now
this.
here, right, the margin goes up, but there's a very good reason, and that's because we're to the right right now of our structure, which means that over time, okay, this T plus 0 line will get closer and closer to the expiration graph, and so we don't mind having a little bit more margin in place when you're on the right of your butterfly. When you're in the center or even a little bit to the left, you got to be cutting down that margin.
Yes, correct.
And this is the last one.
Okay, and then literally for the next 20 days, I did not do anything because the market moved up, market moved down. See, now the current price is at 2022. So in other words, we started at 2042, it ended up at 2084, came all the way down to like 1990, went back up quite a bit, and now it is coming back down. Now it came back down, and now it is coming back up as well. So that second big down, the second big downturn that I showed on the graph, throughout that big downturn, the second one, we literally didn't have to do anything in this trade at all. And on the current margin, we have 12.67%. On our overall margin, it is about 7.2% that we made. And I'm like, the fact that I still survived this and made money out of this was great, so I'm off. And again, we started the trade at around 60 days. We are now about 9-10 days from expiration, so that's a good time to get out. Plus, those are the rules. 8 to 10 days from expiration, no matter what, just get out.
And Max, this goes to your point about, and he's asking what's the gamma that we're comfortable with? I'm always, on this size trade, gamma is always relative to the size of the trade. But, I sleep really well at night when my gamma is, 1 or less. I mean, it can end up reaching a little bit higher. But what ends up happening is that from this point forward, from, I'd say, 2 weeks before, in not the week of expiration, but the week before expiration, during that week, gamma can end up getting very, very high. So that's why, we don't like to end up playing in that week. There, you're basically almost, you're at the whim of the market. Whatever the market does, we don't feel that we have a defined edge in that last, week and a half to 2. So why play? Let's get out. And at that point, we don't have to end up worrying about gamma as much because our T plus 0 line is so flat. Now, remember also what I told you before at the beginning. Gamma or these Greeks are at a specific point in time. One of the things that we will look at all the time is what the Greeks look like being above and below the market when it moves, in case we get any type of sizable move. So when we're going through our fire drill, we'll take a look at that. But, one of the things that you can end up looking at without even going through that level of detail, take a look at what happens with your T plus 0 line. When do you have to start to end up getting worried? And the answer is that even if we go down a little bit here, you can see that, once we kind of get over this peak, it's going to get steeper and steeper and steeper and steeper. So, we would definitely not want to end up playing, okay, past, having positive deltas because it can get ugly very, very fast.
Yep. Oh, yeah. Even though theta is so nice that there is the temptation to stay in the trade for like 2 days more. But every time in my options trading life, every time when I said, you know what, I will get out tomorrow morning, the market either gaps down or gaps up, and I really, really suffer. So now I'm like, this is my plan. I'm following my plan. I don't give a damn. So I have a paper money account where I leave things on until the last day, just to, that part of me that wants that adrenaline rush. It gets it in a paper money account, a live account. I'm like, this is what I'm doing. This is my money on the line. No more, no less. That's it. But usually, sorry.
No, go ahead. Finish.
I was just saying that to whoever asked, to Max, that in this particular trade, when we have about 4 to 6 contracts, I would prefer my gamma to be either -1 or higher. In fact, a couple of times in some of the trades, the gamma has actually been literally at 0 or at plus 0.01. which is pretty cool. To have a positive gamma is like mind-boggling.
That's absolutely beautiful. Chuck is asking in an adjustment, how do we end up picking the difference between the changing a put-call ratio versus rolling a strike with the same ratio? Do you want to go through one of the changes? Do you want me to end up picking any particular?
But I don't understand the question in the sense, how do you pick between changing the put-call ratio or changing the ratio? So between 3 and 4, like, for example, we started the trade with 4 calls and 6 puts versus rolling strikes with the same ratio. Okay, I see what you mean. Well, we start the trade out to make sure that our deltas are actually, remember in the slide, in one of the earlier slides, we said that per fly, our deltas will usually be like -3 to +3. And sometimes it may be slightly, well, actually in the slide it says -3 to +1, but here it is 1.5, but that's because when I looked at the chart, as I said, it looked like the market was going to keep on going up. And I'm glad I actually was slightly positive because at least for the first 4 or 5 days, the market did go up. In fact, it went up so much that on day 4, we had to adjust slightly. Then on day, I don't know, 18 or something, we actually took some off because we had already reached about 7%. Right here on day 18, we took some off. We now went from 4 calls and 6 puts to 3 calls and 5 puts. So I understand what you are asking, but generally we do this when we are slightly biased one way or the other. I know we are considered to be, market neutral traders, but one good thing that I heard and from Tom Sasnoff, and this was in May of 2006 when I was in Chicago, I had this question about, you can't really be delta neutral all the time because one slight move and the damn market or your deltas in a position are going to change. And he said, I never said that you should be delta neutral. I always want you to have a bias in the market because then at least you will know when you are wrong and be able to adjust much quicker. And I took that advice to heed, not because of any other reason except for the fact that I respect him, but also the fact that because I'm a technical trader, I always have a bias. I will look at a chart even though this is supposed to be a delta neutral trade. And that occasionally, actually not occasionally, I would say quite a few times it does help. I'm not saying that the price will go here or will go to this level. I'm just saying for the next few days, it looks like it'll go up a little bit. And therefore, I would rather have my deltas positive. That's all. Make sense?
We'll also end up taking a look at what our different options are and basically run through the scenarios and say, what happens if you end up having think about what ends up happening if you have a perfectly neutral trade in terms of delta. Let me come down here and take a look at where we are. Okay, so we would have to end up being right at this spot, right? Because remember what a delta of 0 says. It says that basically you're at the point of this curve where if we ended up drawing a tangent against it, it would end up being a perfectly flat horizontal line.
Yep.
Now think about what ends up happening if you're at that perfectly flat line. The only thing that can hapen on a move is that you lose money.
Yep. One cent move and you start losing money, literally.
Exactly. So it's a place where the only thing you're trying to do at that point is collecting enough theta not to end up losing money.
Yep, that's right. And George has a question about I have a negative Vega 5 times more than the theta. Any concern for possible increasing IV? Actually, this one of the weeks was when the IV increased more times than at any other time, at least than the 10 highest moves. This was one of the 10 highest moves in the VIX. So we had the IV increase significantly. In fact, if you look at the last right here, it says days in trade was 51. The standard deviation move was only minus 0.26 because it went up, down, and ultimately settled where it was. But look at the IV change, plus 68.53%. And we still survived without really sweating.
You know, the key, the key was that when the only time the butterfly gets challenged is that when you're getting below the money. Okay, and at that point, you saw early on the trade, right? And let me just walk you through, when we start to end up moving down here, okay, what ends up happening is that from this point, okay, we're starting to move down, and we need to worry, because if we continue to go down, at this point, we have risk, right? We try to, and you know, one of the things that I love in terms of designing a trade, and this is what, you know, Himanshu and I ended up talking about, is that you have to go through your profit zone to get to your worst loss. You know, when we were above the money here, right, we were above this butterfly structure, we have to go through our expiration peak before we get to our expiration maximum loss. And as long as you're on the right side of that structure, okay, I know Dave Stewart, okay, in his Take 5, he ends up calling this leaning left, right, because your maximum point is to the left of where you're currently at. You really don't have a lot of risk. So it's very easy to end up managing. And so at that point, what you're trying to do is that you're trying to constantly look and saying, how is my trade look? Is there any way that I can be peeling off profits? Once you get to your profit zone, or once you end up getting to a point where your risk starts to become greater, then you have to take a look and see what you have to end up doing. So at that point, okay, look at what happened with the adjustment. This is the most important part of this whole trade, I think, when it comes to money management. Here you have a maximum risk of about $8,000 if you end up moving down after the adjustment, you can end up seeing what the adjustments were. Right? I know you can always download this, but you take a look at our quantities, right? 3, 5, okay, 3, 5, okay. So we just have straight, it's a split strike at this point, butterfly. And when we end up doing our adjustments here, what we ended up doing is that we just ended up rolling. Okay, you can still see our different strikes. So what ended up happening is by rolling that put down, what ends up happening is you're taking significant risk off the table. Because what we ended up doing, okay, I guess it's kind of, some people would end up calling this, because if you take a look at the put strikes here for a second, 1950 and 1990, so it's 40 points wide. We go basically just rolling down. All we did is roll down our puts, our short puts here, by 10 points. Right? That was the entire adjustment. Right? It was buying a vertical.
Yep.
Okay. But look what it did to the Greeks. Look what it did to the maximum risk. Right? And so what we'll end up taking a look at all the time is how to end up managing our risk, locking in profits, and that's what, when we talk about peeling, okay, that's exactly what we're looking at doing on an ongoing basis. Okay, next question here.
There's a question. Do you have a certain time of day to choose the adjustment? After listening to John Locke, I realized that that was a great way to trade. So I do my adjustments. I look at this particular trade between 2:45 and 3:15 p.m. That's it. And if I have to adjust, I adjust, and then I'm done with the trade.
Next question is, when the VIX spikes, when it's up, is it a good time to end up doing this? The answer is usually. Okay, now here's what ends up happening when the VIX is up. Okay, the VIX is up, but I don't care about some fictitious calculation number. I care about the implied volatility of the strikes that I'm actually going to buy or sell. So what ends up happening is that the overall volatility might be up, but what I also have to take a look at is what, you know, when I talk about skew, All I'm talking about, like when we put this thing on, and let me go back to when this thing is originally on. This is the skew, okay, meaning that the IV of the 1950s is going to be significantly higher than the 2000s, and the 2000s are going to be higher than the 2040s. So when the VIX is up, I'd say it's usually good, but I also have to take a look at what happened to the skew, because if the skew got flatter, which happens sometimes when the market really tanks, means the implied volatility of the at-the-money options goes up higher as a percentage than the IV of the options below the money, then I'm going to end up using a different structure here. So I'm not going to end up using, the same structure of when we are steep, okay? Maybe instead of it being instead of being 40 points and 50 points, maybe if it's flat, it's going to be 40 points and 60 points. Maybe if it's very steep, it's going to be 50 points and 50 points, but I'll use a different ratio. So you see, the answer is yes, it's a good time to do it, but it's just not blindly, oh, here's the set of rules. You have to take a look and see how the skew has changed on it. Okay, so that was the next question.
But Max
there's a certain time today you already asked that.
No, there's another question where he says, in backtest, what slippage did you use? I did not use any slippage here, and that is why we are saying that even though I consistently made more than 12, 14% per trade, I'm saying that we, on average, should be okay with 7 to 10%. So I'm actually cutting down on my costs, because I'm sure, especially lately in the rut, it's trying to get filled on a one lot is like getting to be a pain in the neck. So I'm reducing my total percent profit and saying that we can, and that would be probably the result of slippage and commissions.
Yeah. The other thing, too, with slippage is that we try to end up keeping this so that, I don't worry too much about slippage on the initial trade in. You can trade that if you want as a broken wing. You can do it as two verticals. I don't worry about it tremendously because if there's slippage, we just don't get in. We can end up always waiting. But when you need to end up making an adjustments, most of the adjustments that you'll see will end up being verticals. Okay, because verticals are easier to end up getting off as a trade in terms of slippage and execution. Less legs, nice and simple. Okay, the computer bots that you're trading against understand them. They price the two legs, and they don't feel that they need nearly the edge that they will if you start doing some funky four-legged trade. Okay. Right, so that's important. The other thing I'd end up saying from a slippage point of view is that choose a time, but many times what will end up happening is that if you need to trade in the direction of the market and things are getting ugly in the afternoon, and let's say if the market was going down and it's going down in the last hour and you have to end up buying a put vertical, you're going to pay up for it. You're going to end up really paying up for it. So one of the things I'd end up telling you is make sure that you're trading something that's relevant. If you're trading long-term options, okay, and we're not doing that, right? We're in, but you notice, like, for example, in the adjustment that I ended up giving you, okay, let's go back to the example because I think that that's always best. When I ended up going in the example from this day to this day, all we did was we bought a vertical, and the vertical we bought was closer to the money. Okay? Right, so if you take a look at the puts, right, the puts here were the 1950, 1990, and then we have the 1950, 1980. So it was the 1990, 1980, okay, put spread that we bought, which was the one closer to the money. So we're trading front month, okay, put vertical near the money, okay. That's going to end up giving us the best type of liquidity. If we're going to try to sell something that's, 3 standard deviations below the money and we want to end up getting, okay, at least the mid, it might be difficult. They're going to want more edge on something. On something like this, it's easier for them to hedge, okay? So it depends a lot. If your execution isn't good, sometimes you're going to have to do things yourself. Now, when things get really really, panicky, you may have to end up buying individual options and paying up on the individual options.
Mm-hmm. Another question was the results on the big individual stocks like Google, Apple. Well, in some of the smaller price stock, where Apple now being only $120 stock, our gamma is much higher than what it is here. But Google actually worked out rather well. Most of the times, you can easily walk away with 5, 7, 10%. But then again, you have to be aware of when earnings are coming and all that other stuff. So, I mean, doing this in SPX, up to like, I don't know, a couple $1 million account, this one underlying is more than enough to do very well with. And if you have more than a couple $1 million, then do it in SPX PM, which is identical to this, and now with increasing volume and open interest as well. And it actually, not that we are going to take it to the last day of expiration anyway. So, and then there's the ROT. I'm actually trying this in NDX as well, but NDX moves so much that you can't just do 50-point wide. I'm trying it out with 100-point wide on the put side and 75-point wide on the call side, and putting it on, the same delta of 35. And so far, it's been doing okay, at least in the back tests, or rather the forward tests in a paper money account, I should say. So I mean, this strategy based on the Greek trends is a very, very resilient trade. This is almost in a way like this actually would be almost as probably even more resilient than the Jeep, because in the Jeep you always have positive deltas if you do it the Dan Harvey's way, and then on a day like today or yesterday you would be busy adjusting the whole damn thing properly. But yeah, I mean, this is a pretty resilient strategy, and I got the idea of, also when on Options Tribe, when John Locke was saying that in the rut he puts on a bearish butterfly, 15 to 25 points below the market and buys a deep in the money call. I remember him saying, I think it was him saying or somebody else told me that what John Locke actually said was that you can actually do a bearish butterfly, a bearish classic butterfly, or an iron butterfly. And that is when I realized that I remember having heard this before from Jim. So I went back to his slides and I'm like, okay, what if John Locke is saying and Jim is saying this, and I heard Jim like 5 years ago saying this, maybe I should check this out. And I did. And I'm very, very happy with the results. This could not good. This is probably, I already have trades in the RUT and SPX right now in multiple accounts, and there is a great possibility that by the end of this year, this could well become my bread and butter trade. Then I will use my calendars just to adjust the Vegas. As George was asking, the Vega is very, very negative here. So having a calendar on the side will balance out the Vegas, the deltas, the gammas, and the thetas. And that's the armadillo trade.
Right. Also, remember, we don't mind being short Vega after we've just had, the 5th largest weekly move in VIX history.
Not that we knew that at that time, but still after those.
No, but if you take a look at the dates, right, our Vega gets much worse, okay, as it goes up, or at least the P&L ends up hurting a lot that way. So you have to also take a look at it. Would I like to end up being, negative Vega when, we have started to gone down and the VIX has jumped hugely by going from 11 to 12? No, I don't want to be short at that point because I know it can get a lot worse. But, after you end up having, like I said, one of the 5th worst moves in history, in terms of the percentage that the VIX moved, the weekly percentage that the VIX moved, you don't mind being a little bit negative. The other thing that I end up, really stressing, because it took me a while to figure this thing out, some people fall in love with this theta. Okay. And if you've fallen in love with a theta, I'd suggest you go and watch the movie Moonstruck, and to quote Cher, snap out of it. Okay, you can't fall in love with it. Okay, Yeah. By the way, one of the great movies here, right? Nicolas Cage tells Cher that he loves him. She slaps him in the face. He doesn't move. Slaps him in the face the second time. He goes, snap out of it. Anyway, you can't end up falling in love with any part of your trade, because I'll tell you what ends up happening is that the gamma doesn't look too bad here, and the gamma would actually, not look much worse, okay, once you got to the top. It'd start to end up getting worse, but it starts to get really ugly once you start to go down the backside of it. And the problem is that after we've had this level of moves, how do we know we're not going to have another, 30-point move? Okay, and have it continue to end up sliding and now if we drop 30 points, okay, not only do we end up, our loss is going to be a lot worse than this. Why? Because our gamma is negative. So at this point, you kind of have to end up realizing, hey, you fought a great fight, you've made your money. I'd say that probably the two biggest problems that I've seen retail traders make is, one, they trade too large, and two, they stay in trades too long because they start to hope. Hope is not a strategy. Right? Hope is not a strategy. I hope it doesn't go past here. You have to, if you go and you take a look and you analyze your trade, what's the worst thing that can probably happen to me? It's amazing. It's like the market knows. The worst thing that can happen to your trade usually will happen to you. And if it doesn't, okay, today, it will soon.
Mm-hmm.
So we've been going just about an hour. Any other questions? Okay. In the slide deck, I'll just make a comment so that you guys don't have to, for the lazy people amongst us, if you wanted to, I ended up putting the slides from the initial presentation. It's about 5 years old. I copied pretty much the relevant stuff. If you want, you can end up searching on our website to end up finding some of the old ones. I don't know if we have available the initial stuff that I had done for the SIBO back 5 years ago, but these are basically, we're cut and paste of those slides, so you guys have it. Himanshu, anything in closing?
No, I hope the folks who heard it understood it. Hope they realize that you can actually make significant amounts of money in iron butterflies as well. You don't have to do have condors and calendars only. But other than that, no, I'm sure as they digest this, they may have some other questions, and if they do, let us know, and we will set up another hour to answer your questions. We haven't decided yet, but we may have a service regarding this as well down the line. And I believe it won't be just 2-3 weeks. Once you put on a trade, until the trade is over, we want you to actually have a couple of trades under your belt and then decide whether you want to continue or not. That way, you will have enough knowledge by then as to whether you would like to or not. 2 weeks ain't good enough. I know it ain't good enough for me, so I'm assuming it's not good enough for you guys as well. Yeah, makes sense, Jim?
It definitely does. It really does. One of the other questions that was just coming up, Himanshu, is where can they get it? Tom will end up, and he posted this thing. He'll end up posting, okay, where you can end up seeing, where you can end up downloading everything, and also, right to Himanshu or Tom or myself. If you guys want to see more of this, like we said, we'd be more than happy to kind of end up going through, trade in detail, because we kind of had to do the whole overview, give you the background and everything, and go through some more of the specifics. If there's enough interest, okay, Himanshu will end up making this actually another service, okay, and he'll add it to, some of the other services that he does. As Himanshu ended up saying that this trade is getting to the point where it's going to become his bread and butter. These principles, okay, of the trade of, managing butterflies, whether they were, Kevlar stuff that I had done, okay, for a long time, or whether it would be, John Locke type stuff, I've seen a whole bunch of other stuff. I know that Dave Stewart does one a little bit different. Harvey, Dan Harvey used to end up doing one, again, different types of principles. They all use the same type of functionality, and what you need to do is you need to end up seeing which one you end up liking. I like this one the best. Obviously, it's the one that I worked on. I had looked at all of the others, and I consider guys like Dan Harvey and John Locke, Dave Stewart, others, Paul Demers, we worked on a long time. Consider them not only colleagues but friends, and we really looked at how to end up making as much money with risk. One of the things that John Locke once told me when he was when he tutors students, if they've made too much money in a back test on a given month, it's a problem. Okay, it's a big problem. And the reason, right, you're laughing, Himanshu, I know it, you know it, but a lot of students say, well, how could be making too much money, okay, be a problem? The problem is that we know the month, we know the trade, and if you've made more money than what you should have, it meant that you took more risk. And you got lucky, okay, you got lucky. Okay, that's why you made more money. We know that in certain, if you give a certain month and we go through this, we know what's a reasonable amount to end up making. We know how much risk that we'd have to end up taking. And to be able to end up, because, we've played every single scenario out that we could in an environment. And it always has to end up being, it's not just the back test. It's about how ugly, can things end up getting. Okay, and that's what you need to end up working on.
That is correct.
Well, thanks very much, Jim and Himanshu. Great presentation. Really enjoyed it.
Thank you very much, Tom. You made it possible.
Thank you, everyone.
All right, guys. See you all. If you have any questions, feel free to shoot us an email, either me or Jim or Tom. We will be glad to answer any questions that you may have.
You can also post your questions in the forums at forums.capitaldiscussion.com.
Yes, certainly. Yes, you can do that too. That might be better. Everybody hears. Okay.
Right.